Welcome to another deep dive. Today we're taking a deep plunge into a truly fascinating topic. I mean, it impacts every single one of us, right? Whether you're, a seasoned investor or maybe just starting to think about saving for the future. The material we're unpacking today points to this really profound truth, which is that the biggest battleground for your financial success isn't out there in the stock market, not really, or inside some big financial institution. No, the real conflict, the most critical war, let's call it, it's being waged right inside your own head when it comes to money. So our mission with this deep dive is, well, first, to expose these invisible enemies, the things that silently mess up our financial goals, and then, crucially, to reveal a blueprint, a solid plan for building a really resilient investor mindset. Okay, let's unpack this and get started.
Yeah, it's so easy to fall into that trap, isn't it? Believing that investing is just about numbers or charts or having some magic touch for picking the perfect stock at the perfect time. But as the sources we looked at really powerfully show, that's often just, well, it's a fundamental misunderstanding. The real battle, the one that ultimately decides your financial path and maybe even more importantly, your peace of mind, it's deeply psychological.
Ah.
We're going to dive deep into how these common emotional traps, these really ingrained human responses that, let's face it, affect all of us, how they consistently lead to costly mistakes, sometimes really devastating ones. And then once we've shone a light on those pitfalls, we'll pivot. We'll look at a set of actionable principles, things designed to fundamentally change how you approach things, turning a struggling investor into what these sources call a master investor. And what's really fascinating here is just how universal these psychological traps are. It doesn't matter how much experience you have or what the market's doing or even what you're investing in. These patterns just repeat and repeat. So yeah, prepare for some genuine aha moments. Things that will definitely reframe how you think about your money and maybe even more critically, how you choose to interact with it.
That's such a key distinction right off the bat, this core misconception that investing is, you versus the market. Like success comes from being smarter, finding some secret edge, outwitting the external forces. But what these sources make so clear, and this is where it gets really interesting, the market is not your enemy. Think of it more like the playing field. Huge, complex, sure, but ultimately neutral. The actual adversary. The thing that truly messes up your financial progress. It isn't external at all. It's your own psychology. It's that whole tangle of emotional traps, biases, gut reactions,
Yeah.
all happening right inside your head. And this internal war, it's relentless, isn't it? It needs constant awareness and its outcome, like you said. It doesn't just determine your financial future, but also your day-to-day stress levels, your peace of mind, just your general well-being navigating the world of money. It's a huge shift in perspective if you're serious about success.
It really is. Understanding that internal dimension, recognizing that the biggest challenge is within you, that's arguably the single most crucial first step towards, well, mastery in investing. And probably one of the most prominent and, let's be honest, most destructive of these internal enemies is what our sources really sharply call the panic trigger.
Oh, this one, yeah. This hits home for pretty much anyone who's ever had an investment, I think.
Yeah.
I can vividly remember times I've felt it myself, and I bet a lot of listeners can too. Just think back to a time you saw your portfolio take a serious nosedive, like a real drop, the kind that makes your stomach just clench up, your heart start pounding. Maybe you feel that cold sweat. You turn on the news, and suddenly every headline is screaming, recession, market crash, the end of the world as we know it. Your friends, colleagues, random people online are all talking about one thing, sell, 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 get out while you can, and then boom, that primal gut instinct just takes over. It's not a quiet voice. It's a full-on scream inside your head, right? Get out now. Stop the bleeding. Save what's left. It's this incredibly powerful, almost overwhelming urge to just react. Hit sell before it gets worse.
That visceral reaction, that undeniable feeling you're describing, it's perfectly explained by this deep-rooted psychological thing called loss aversion. Our brains, research shows, are basically wired to feel the pain of a financial loss about twice as intensely as the pleasure of an equivalent gain.
Twice.
Yeah. So when your portfolio drops significantly, that negative feeling isn't just bad, it's incredibly intense, acutely painful. It's like a primal alarm bell. Your brain, in this evolutionary attempt to shield you from that pain, essentially overrides your logical thinking.
Right.
It sends this powerful, urgent signal. Stop the bleeding, get rid of the source of pain now. And look, that instinct might have been great on the savannah, facing down a tiger, but it is almost always disastrous when it comes to long-term investing. It's a mechanism built for short-term survival, absolutely not for long-term wealth building.
And here's the really brutal part about giving in to that panic trigger. When you actually hit sell during a big downturn, you aren't saving yourself from more pain, even though your brain is screaming that you are. What you're actually doing is locking in your losses. You're making them permanent. You take what might have just been a temporary dip, something markets historically always recover from, and you turn it into a real, irreversible loss. The data on this is just incredibly clear. Study after study, looking back decades. Think about the dot-com bust, or 2008. Millions panicked, sold everything, and then completely missed the massive recoveries that followed. The research consistently shows that the people who make the most money in the markets long-term are often the ones who do the least. In terms of frantic trading, reacting to news, they stick to their plan, they ride out the storm, while everyone else is stampeding for the exits. It's so counterintuitive, isn't it? Doing less actually leads to more profit.
Wow.
It is completely counterintuitive. And for what the sources call the master investor, this perspective is just fundamental. They get that a market correction, a dip, even a full-on bear market. It's not some freak accident. It's just a normal, cyclical, inevitable part of the journey for financial markets.
Right, just part of the deal.
Exactly. It's not a signal to abandon ship, to toss your strategy overboard. No, they see these times for what they are. A test of discipline, which naturally raises that crucial question for all of us. How do we actually build that discipline? How do we manage to override that deep primal urge to run when our brain's yelling, danger? It really starts with understanding that impulse, acknowledging its power, and, critically, having a solid framework ready before the panic hits. Maybe that means setting up automatic investments so you buy regularly no matter what. Or consciously limiting how often you check your portfolio, turning off those damn news alerts that just feed the fear.
Okay, so from the icy grip of panic, we pivot to an equally powerful but kind of opposite trap, the FOMO frenzy, fear of missing out. This one isn't about the pain of loss. It's about that other nagging pain, regret.
It's absolutely the flip side of the coin. But yeah, often just as damaging to your long-term financial health. Picture this. You see some stock or a new asset class, maybe crypto, maybe some sector, just go on what the sources call a parabolic run. Prices are just shooting up, defying gravity. Everyone's talking about it. Your friends are bragging about the quick money they're supposedly making. And suddenly that same inner voice that urged you to sell in a crash, it's got a new message, but this was intoxicating. You're missing out. The next big thing, get in now before it's too late. Don't get left behind. It's this really potent, almost magnetic pull of feeling left out of easy gains.
That's the FOMO frenzy right there. In all its dangerous glory, it's pretty much driven entirely by greed and, crucially, by the seductive illusion of easy money. And this is exactly where people just toss their strategy out the window. All the research they did, the disciplined rules they set up, gone. They just throw caution to the wind, desperate to jump on this hot trend that, let's be real, has probably already peaked. It's like showing up to a party just as everyone's leaving, right? You missed the fun, now you're just stuck with the mess. A perfect, painful example from the sources, still fresh in everyone's mind, is that whole meme stock craze a couple of years back. Driven by hype, stories of quick riches sticking it to the man. Loads of people piled in when prices were sky high, and sadly, a huge number of them just got absolutely crushed. Learn the hard way about chasing hype instead of value. And this isn't new, is it? Think tulipmania.com bubble. Same psychology, different century.
Precisely. A master investor just doesn't chase those fleeting mirages. They don't gamble on hype. Instead, they patiently, systematically build their fortress, as the sources put it. A well-thought-out, diversified portfolio designed for their long-term goals. They deeply understand that the market, in its vastness, offers real, value-based opportunities every single day.
Right. There's always something.
Always. There's just no need to desperately jump into one single overheated trend driven by mass excitement. The biggest asset here isn't some secret tip or fancy software. It's patience. Simple, boring patience. It's that calm belief that good opportunities will come along if you just wait for them to fit your strategy, your criteria. Instead of chasing every shiny object the crowd points at, they ask, is this fundamentally sound? Does it fit my plan? What's its real value, not just its current hype price?
So what does that mean for us navigating this stuff? It means actively fighting that urge to jump on every single bandwagon, understanding that patience isn't just nice to have. Financially, it's probably your most powerful strategic weapon. Okay, now for the final emotional trap, and maybe the sneakiest one, because it doesn't show up when you're scared or greedy. It shows up after you've done well. This is the overconfidence bias.
Yeah, this one's tricky because it starts from a good place, right? Success. It usually pops up after an investor's had a pretty good run, maybe a few winning trades, picked some stocks that did well, or just ridden a nice bull market. And this can lead to this subtle but really dangerous psychological shift. You start to think, hey, maybe I've got a special insight here, a real knack for this. You feel kind of invincible.
The Midas touch.
Exactly. And the sneaky part is it feels good. It feels like real skill, like you've cracked the code. But often it's just masking what was really luck or just being in the right place at the right time, a rising tide lifting all boats. The brain messes up, attributes the success to personal genius instead of just, circumstances.
And when you start feeling that little bit invincible, that's where the danger really kicks in. The sources we looked at, they highlight this almost predictable pattern. You might stop doing the homework, the research that maybe got you those early wins. Why bother if you're a genius,
Yeah.
right? You start taking on way more risk. Maybe putting everything into one or two speculative bets, ditching diversification. You start straying from your original discipline plan, thinking you're somehow beyond it now. The sources are blunt. You start making reckless bets. You're convinced the winning streak will just go on forever, that you're immune to downturns. It's such a classic setup for a fall. We've seen it happen so many times.
And sadly, the market